Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media like we normally do. I'm going to interject my financial opinions as we go, generally related to wealth building, commodities, and/or financial topics. So we're going to dive right in. We're going to take a look and see what people are sharing, and I'm going to interject a whole bunch of my opinion here. So let's see what they're talking about. If you want to follow me, it's at finding_finance. And if you want to follow and join our community, finding-value.com. That's where we dive deeper into these topics. We're going to dive into one topic here about the housing market. And we do have a coupon code going on, Mayday, Mayday, one word, if you're interested in joining up. It's a 50% discount on the first month if you just want to try it. And it's a much larger discount on the yearly membership if you want to either originally sign up for a yearly membership or you want to transfer your monthly membership to a yearly membership, you still get savings. So David Orr, I'm going to start here. He's talking about Margin Call, which is a movie. If you haven't seen it, you probably don't like finance because it is finance and real estate related. He said, an underappreciated point of the movie Margin Call. If you're great at knowing when the music has stopped, then at very large scale, you're stuck and will be forced to take a loss anyway. If you're truly great, you might even prevent a blow up and only take a major loss instead. At small scale, you could have exited all of your positions in the first 10 minutes of the market opening, and you could have even flipped short in large size in the next 10 minutes and warned your counterparties of the impending doom and why. You had the exact same skill level as the larger scale guy, but now your firm is booming like hell. I'm just going to go back to that time frame. You actually had a whole bunch of warning signals before that crash occurred. So it was a culmination of a bunch of different things that occurred there. And I'm just going to show you real quick some of the things that I was looking at, or I would look at if I were looking at this. We were coming off of a big boom in the housing market. This here is the United States housing starts. It peaked and rolled over and definitely broke its uptrend line in April of 2006. So the first warning sign occurred in April of 2006. But you don't have to pay attention to it because there is built up momentum in the system of these credit creation homes and all the loans coming into the system for a good 18 months or so. Now, this is on a longer term time frame. So you've got about 18 months from this peak to where things could fall off a cliff like they did. You could also have waited when we went back below the long-term average, which is that white line going across. That was back in August of 2007. The crash hadn't occurred till middle to late September of 2008. So this was also another warning sign. So you had the rollover, first warning sign, the second warning sign of breaking below the average, which is basically you are going into a recession in your housing starts. They are collapsing. You could have looked at foreclosures. You could have looked at um, a lot of indicators that were all screaming like there's a huge problem. Foreclosures was one of them. The housing starts breaking below the average here in 2007, August of 2007. And then you also had other indicators that we were probably close and ready for a recession, like spiking crude oil. Crude oil generally spikes right before a potential recession, and that peaked in June of 2008. Another number three problem. Then you look at the home builders, something like Leonard Corp. Leonard Corp is a large home builder. And if you were to look back at that potential top, we had a head and shoulders top, 2004, 2005 was the ultimate peak. And then it rolled over in March of 07 and broke its downtrend in June of 07. Its head and shoulder pattern broke to the downside. So that was blaringly obvious to me if I were to look at all of this information that a top was definitely in place. And no, we do not have a top at this moment. So, looking back at this and then saying that he could do this all in the same day, um, there was a whole bunch of problems if you were in that still. You could have also used the yield curve. The yield curve of the twos and tens also would have shown a major problem. Um, in 2006, it peaked. We started rolling over, and then it became blaringly obvious, I would say, in about late '07 that a problem was occurring as the 2 and 10 year was diving in free fall. So if someone said you had a ton of inventory, home inventory, existing inventory that was climbing from '05, '06, '07, housing inventory was climbing like heck. You had the home builders rolling over in '05 and '06. You had housing starts that broke below in 2007. You had a dive bombing 2 and 10 year right in your face. I'm just going to say this, guys. It was obvious as heck. It would be easy to call that a potential crash would occur. Now, the timing of the crash, I probably wouldn't have nailed the timing in 2008 of September. I would have probably been exiting the stocks in somewhere around 2007 is probably where I would have been like, you know what, I'm pretty much good here. And it probably would have been, somewhere in this vicinity of about December of '07. That's where I would have been like, you know what, we got a problem here, guys. there's a problem, and I can see it across. There's a confluence of information of like 10 different things that you could follow that are like, wow, we are going to have some problems here. So that's my kind of take on it, running you through what I look at and potentially seeing what a problem could be. So I don't think this came out of nowhere. I mean, predicting it on the day or the week, yeah, you're not going to be able to get that. But I think you can get within 6 months of it. Patrick Karam says, "What are you betting on?" So he's got this cool chart that he put on here, and I do like the chart quite a bit. So let's go over it real quick. What this is the gold monthly log at the top, so it's logarithmic. We've got a continuation breakout that just recently broke out for gold. At the same time, if we look at the US dollar adjusted for inflation, we are breaking down to the downside. We just did a retest, and it looks like we could potentially roll over for the dollar. Where this would put us is kind of like the 2002 timeframe, where we had a big move lower in the dollar back in the early to mid 2000s. This would be another leg lower. Your consolidation period was from 2011 all the way till the breakout of what we just had this year. And now we're starting to roll over what you got here and potentially could fall lower. That's going to be jet fuel for anything priced in dollars, particularly gold, silver, platinum, and all of those commodities that we watch that are priced in dollars. So that's when the big bull market took off. And you know what did really well? Emerging markets. And you know what's doing a breakout right now? Emerging markets. It's all tied together. Coming down, which would you rather have? $1 million in paid off real estate or 1 million in the stock market? Well, I mean, hmm, I would rather have 1 million in the stock market because I know the stock market better than I know real estate. And I can generate probably dividend yields of over $100,000 a year on $1 million in the stock market than I could off $1 million of real estate. So I could generate a return of probably 10 to 15% in dividend yields of my favorite commodity companies with a bunch of upside on the dividends and on the stock itself. Um, but if I knew real estate, I would have chosen real estate then. Here's Jim Simons or Simmons. Just passed away. It's the man. It's the man who solved the market, I should say, not Maine. But here's a couple of quotes he's got. Let's go over them real quick. He says we have three criteria. If it's publicly traded, liquid, and amenable to modeling, we trade it. He says, in this business, it's easy to confuse luck with brains. One can predict the course of a comet more easily than one can predict the course of Citigroup's stock. The attractiveness, of course, is that you can make more money successfully predicting a stock than you can a comet. Because I want a guy who knows enough math so that he can use those tools effectively, but has a curiosity about how things work and enough imagination and tenacity to dope it out. Because those kinds of times when everyone is running around like a chicken with its head cut off, that's pretty good for us, taking advantage of that. I wasn't the fastest guy in the world. I wouldn't have done well in an Olympiad or a math contest. But I like to ponder, and pondering things, just sort of thinking about it and thinking about it, turns out to be a pretty good approach. I actually do that. I think a lot about these types of things. One can predict the course of a comet. Oh, okay, we already did that one. Those kinds of times when everyone is running around like a chicken. What the heck? Why is he reposting these? Past performance is the best predictor of success. I think that's a joke, though. Anyway, that's what we've got for the quotes from Jim, who has recently passed away, unfortunately. Fibonacci Investing says you may want to inform your followers of this, which is the business cycle. And actually, this is pretty much laid out quite well. So, in early expansion, industrials, materials, energy is a late expansion mover. We've got healthcare, consumer staples, and then at the peak, utilities. And I know some people ask some questions about some of these sectors. Um, After you get the peak, you have a slowdown or a contraction. This is generally where bonds do well too. We've got consumer discretionary when you get to the bottom, financials and technology in the trough at the bottom here. And in the recovery phase, technology, which is the initial recovery, technology does very well. Low inflation, low interest rates, technology, where the money rotates. So I think that technology is going to lose some speed, and these guys are going to start to pick it up here. Because I think we're already we're almost through the early expansion, or the mid-cycle wobble. You could even say that we're still potentially in the mid-cycle wobble still. But we're going to get into early expansion, and then late expansion eventually. That's when energy goes ballistic. It did really well. We're still in a bottoming pattern. We're in the right-hand shoulder of the bottom, and we haven't actually gotten into the late expansion yet, in my opinion. Got Chris in Canada. He says Nat gas bulls will like this interview. Bond Guru thinks that $8 will be the new normal for natural 2028. Expects the Fed to cut rates by elections. Can't raise or maintain due to financial crisis risk and surplus of cheap debt. He thinks 3 to 4% will be the new normal in inflation. That's his opinion, and I'm glad that he has an opinion that natural gas at $8 will be the new normal in 2028, and that'll be good for me. I'll just say that because I'm a nat gas investor. Well, for me, the NXE financing is just simple math. They see the same opportunity as DNN, UEC, and URC, although a bit later. Uranium is scarce, and we will probably see prices in the range of $200 to $500 a pound in the coming years. Then any deal to buy uranium at today's prices makes perfect sense. Exactly how they will use these pounds, they probably don't even know yet. But if you're confident the uranium price will spike, it will be a benefit for your company. So these guys are speculating and trading uranium, and they're not even running their business. That's what gets me a little bit irritated with some of these guys. Produce the uranium then. It takes some time. I shared a Peter Lynch talk about pullbacks in the stock market. I'm not going to go over them. Here's Isabel Net on assets. This is the price of real assets relative to financial assets being very low suggests that investors should consider owning more real assets, such as real estate and precious metals. And this is going back all the way to 1925. And this is the ratio of real assets versus financial assets in terms of the relative price. So when we look at relative price, you can see that we were falling, falling, falling. We had a big move in the mid 1960s all the way up to the early 1980s. Huge move. And then we had a big consolidation here. And we, in my opinion, are at a bottom here. If you look at Elliott wave and you were to study this chart here, you could tell that we're at a bottom here. The Elliott wave would suggest you get this pullback, and then you get this other hump type move. And you know what? I'll pull it up real quick and show you what I mean by that pullback there. And it's right here. This here you get a 1, 2, 3, 4, 5 pullback, then you get an ABC correction, and then you get a 1, 2, 3, 4, 5 pullback. So if we were to go back here, you get a it's real big here. So you come down, you come back up, and then it's 1, 2, 3, 4, 5 pullback. You get an A, B, C correction. Then you get another 1, 2, 3, 4, 5 pullback, which puts you roughly at this bottom here. If I were to zoom in on these sections here. So I think that this is a definite bottom. We're going to be turning on up, and hard assets are going to perform, or real assets are going to outperform financial assets. They generally do that in an increasing interest rate environment with high inflation. And that's the exact market conditions that we have. So it's going to be very similar to this move here, but it could even be bigger. We'll see. And the reason I think it could be bigger is because of the imbalances in the market. How much money is over in the financial assets, and on top of it, how hard it's going to be to have a supply response from commodities. That's why I think it could be bigger. But coming up, Bloomberg didn't count underreported buying nor Chinese private hoarding in recent years. So this private and official Chinese gold reserves, and look at this thing go here, guys. Massive move upward, and Chinese are accumulating and hoarding gold for, I'm sure, very good reasons. President Biden says, my dad always used to say that the way you build wealth is by building equity in your home. My housing plan would help Americans achieve homeownership by giving households $400 a month for 2 years when they buy their first home. And when you get to the later stages of these big blow off bull market in real estate, the expansion phase, the affordability gets bad. And then what they're going to do is they're going to try to help people buy homes. They come out with these plans. Obama did it, $8,000 credit for a first-time home buyer. He's talking about $400 a month for 2 years. This is generally signaling kind of where we're at in the real estate cycle. And I think that we're smack dab in an area where we could accelerate greatly to the upside for house prices and the volume of sales. And it's predicated on affordability getting a lot better. So if we keep rates high and they don't do these programs and the rates don't move, you're going to be like frozen. If they lower rates and they start doing this stuff, you could see a big boom in real estate for a period of time, which is dealing with the affordability. Lynn says some analysts say that monetary policy is not tight enough to curtail inflation. Monetary policy is this here. It's this bank lending that they're basically trying to prevent inflation coming from bank lending. He says the real issue is that fiscal policy is too loose to curtail inflation, and at a greater than 120% public debt to GDP ratio with ballooning interest expense, tighter monetary policy loosens fiscal policy further. So they're in a catch-22 where if they try to tamp down monetary policy, bank lending, they get screwed and they stimulate the economy with higher rates because of the fiscal policy and the debt. Giovanni says U.S. air travel, which is the TSA total traveler throughput in million passengers, the 7-day average here is 7.1% above 2019 level. We are at new highs for this time of the year for travel. U.S. real retail sales 0.77% year over year. Retail sales are flatlining, and they generally do that before a slowdown or a recession. So maybe we are going to experience a slowdown potentially. But I do think that maybe Powell's going to come riding in on his horse and start lowering interest rates before maybe that occurs because we are in a presidential election year. Here's a Jim Simons quote. Success in investing is not about being right all the time. It's about minimizing losses and maximizing gains. Don't be afraid to take risks and embrace failure. That's where the best opportunities lie. His opinion there. Got Kevin here. I wanted to read a couple of things that he wrote. First one, he said nearly all mining stocks will 10x because gold is likely to 5x. $10,000 gold in 10 years or less. Probably way less, something like 3 to 5 years. This could see silver run to $200. But don't get too excited because Big Mac meals will cost $50. Most real stuff will 5x. Stocks that make real stuff will 10 to 20x. Stocks that are currently in a bubble will do little, 1 to 2x, and get killed in relative to inflation. So a lost decade for the current bubble darlings. And you know what? I completely agree with them. I think that we're going to see the technology stocks move sideways. Same with maybe a lot of the S&P 500. And then you're going to see the real hard asset stocks do real well. So I agree with him. He says oil hit 100, it's about 150 last cycle. I forget. Anyhow, I think we could easily hit $500 a barrel in the next 10 years because many global producers aren't going to be willing to exchange oil for money. You can't just create money like this and not expect this scenario I'm painting to play out. It's unstoppable. And I agree with him. It's coming from the weakness of the dollar. And we could see some ridiculous price on oil. Completely agree with you. PE ratios at previous market bottoms. We can see PE ratios at bottoms here pretty low. 82 would have been a really good time to buy stocks. That's probably the most beneficial time. And some of the market drivers for stocks is lowering inflation or disinflation, is what we call it, a good valuation, and also a declining interest rate from a high level. That's the best, most opportune time to buy stocks. So 82 is like the best of the best out there. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you guys later. This is Finding Value.